The idea of a BRICS currency has gained significant global attention in recent years as major emerging economies seek to reduce their dependence on the US dollar. The BRICS group, comprising Brazil, Russia, India, China, and South Africa, represents a large share of the world's population, natural resources, and economic growth. Together, these nations are exploring ways to reshape the global financial system by decreasing their reliance on the dollar for international trade and financial transactions. This effort reflects a broader shift toward economic independence, financial security, and a more balanced global monetary order. For decades, the US dollar has dominated global trade, serving as the primary currency for commodities such as oil, gas, and raw materials. Most international transactions, even between two non-US countries, are settled in dollars. While this system provides stability and liquidity, it also creates vulnerabilities for countries that depend heavily on the dollar. Exchange rate fluctuations, US interest rate policies, and political decisions in Washington can directly affect the economies of nations thousands of miles away. For BRICS countries, this dependence has increasingly been viewed as a strategic risk. One of the main motivations behind the BRICS currency initiative is the desire to reduce exposure to dollar-based sanctions and financial pressure. In recent years, sanctions imposed by the United States and its allies have demonstrated how powerful control over the global financial system can be. Countries that rely heavily on dollar transactions can find themselves cut off from international payment systems, frozen out of trade, or unable to access foreign reserves. For nations like Russia and China in particular, this has served as a wake-up call to develop alternative systems that reduce vulnerability to geopolitical pressure. By promoting trade in local currencies, or creating a shared BRICS-backed currency, member nations aim to increase economic sovereignty. Instead of converting their money into dollars before conducting trade, countries could use their own currencies or a common BRICS unit for settlements. This would lower transaction costs, reduce exposure to currency volatility, and strengthen domestic financial systems. Over time, it could also encourage greater regional trade and investment among BRICS members, strengthening economic cooperation within the bloc. Another important goal of the BRICS currency initiative is to reduce the global dominance of the US dollar. Currently, the dollar serves as the world's primary reserve currency, meaning central banks across the globe hold large amounts of dollars as part of their foreign exchange reserves. This gives the United States a unique advantage, allowing it to borrow more easily, finance deficits, and exert influence over international financial institutions. BRICS nations believe the system is unbalanced and does not fairly represent the economic power of emerging markets. By developing an alternative system, BRICS countries aim to create a more multipolar financial world where no single currency dominates global trade. This does not necessarily mean replacing the dollar entirely, but rather reducing overdependence on it. A diversified system, where multiple currencies play significant roles, could provide greater stability and fairness in global finance. It would also give developing countries more control over their economic futures and reduce their exposure to external shocks. The concept of a BRICS currency also reflects long-term strategic thinking. China, for example, has been steadily promoting the international use of its currency, the yuan, through trade agreements and infrastructure investments under initiatives like the Belt and Road Initiative. Russia has increased the use of local currencies in trade with friendly nations. India and Brazil have also explored bilateral trade settlements without using the dollar. These steps, while gradual, indicate a broader movement toward de-dollarization. However, the creation of a unified BRICS currency is not without challenges. The 5 member countries have very different economic structures, levels of development, inflation rates, and monetary policies. Coordinating these differences into a single currency framework would be extremely complex. Unlike the European Union, which spent decades aligning economic policies before introducing the euro, BRICS nations operate under diverse political and financial systems with varying priorities. Trust is another key issue. For a shared currency to succeed, participating nations must have confidence in each other's economic stability and financial discipline. Exchange rate management, interest rate policies, and fiscal responsibility would need to be carefully coordinated. Any major imbalance could undermine the credibility of the entire system. As a result, many experts believe that the BRICS currency will initially function more as a trade settlement mechanism, rather than a full replacement for national currencies. Despite these challenges, even limited progress toward a BRICS currency could have a significant impact on the global financial system. Increased use of local currencies in trade reduces demand for the dollar and weakens its monopoly over international transactions. Over time, this could gradually shift the balance of power in global finance, giving emerging economies greater influence in setting economic rules and standards. The push for a BRICS currency also aligns with broader global trends, such as digital currencies and financial innovation. Some discussions have included the possibility of a digital BRICS currency, backed by commodities like gold or other assets. Such a system could improve transparency, reduce transaction costs, and increase trust among member nations. Digital platforms could also make cross-border payments faster and more efficient, reducing reliance on traditional Western-dominated payment systems. For developing nations outside the BRICS group, this shift could offer new opportunities. A more diversified global currency system could reduce exchange rate risks, lower trade barriers, and provide alternatives to dollar-based financing. Countries facing dollar shortages or economic pressure may benefit from having more options for trade and investment. At the same time, the rise of a BRICS currency would likely reshape global geopolitics. Financial influence is closely tied to political power, and any reduction in dollar dominance would alter international relationships. The United States would still remain a major economic force, but its ability to influence global markets through monetary policy alone could diminish over time. This transition, however, would be gradual and complex, unfolding over many years rather than overnight. In conclusion, the BRICS currency initiative represents a significant step toward reducing dependence on the US dollar and creating a more balanced global financial system. By promoting trade in local currencies and exploring a shared monetary framework, BRICS nations aim to strengthen economic independence, protect against external financial pressures, and increase their influence in global affairs. While challenges remain in implementation, the movement reflects a broader shift toward multipolarity in the global economy. As the world continues to evolve, the BRICS currency concept may play an important role in shaping the future of international trade and finance. The idea of a BRICS currency has attracted global attention because it represents a potential shift in how international trade and finance operate. While the concept offers promising long-term benefits, its implementation remains complex and challenging. The BRICS nations, Brazil, Russia, India, China, and South Africa, differ significantly in economic size, political structure, inflation control, and financial stability. These differences make the creation of a single unified currency a difficult task. However, even without a fully unified currency, partial adoption through local currency trade or alternative settlement systems could still significantly reduce global dependence on the US dollar and gradually reshape the international financial system. One of the biggest challenges facing the BRICS currency is economic imbalance among member nations. China's economy is far larger and more industrialized than the others, while South Africa's economy is comparatively smaller and more vulnerable to external shocks. Inflation rates also vary widely across the group, with some countries experiencing stable price levels and others facing frequent inflationary pressure. A common currency requires strong coordination in monetary policy, fiscal discipline, and interest rate management, conditions that are difficult to achieve when economic priorities differ so greatly. Political diversity also presents a major obstacle. Each BRICS nation operates under a different political system, governance style, and economic philosophy. Coordinating financial policy among countries with different strategic interests can be challenging. Unlike the European Union, which spent decades building economic and political institutions before launching the euro, BRICS lacks a unified regulatory or financial authority capable of enforcing monetary discipline. Without strong institutional coordination, maintaining a shared currency becomes far more complex. Another key challenge lies in currency trust and stability. For any currency to succeed internationally, it must inspire confidence among investors, governments, and financial institutions. Trust is built through transparency, economic stability, and consistent monetary policy. At present, investors still view the US dollar as the safest and most liquid currency in the world. The dollar's long history, deep financial markets, and global acceptance give it an advantage that no BRICS currency currently possesses. Convincing global markets to adopt an alternative currency will take time, consistency, and proven reliability. Despite these challenges, the long-term potential of a BRICS currency remains significant. Even partial implementation, such as settling trade in local currencies rather than dollars, can have meaningful economic effects. Several BRICS nations have already begun trading oil, gas, and other commodities using their own currencies. This reduces dependence on the dollar, lowers transaction costs, and minimizes exposure to exchange rate volatility. Over time, such practices could reduce global demand for the dollar and weaken its dominance in international trade. One of the most important motivations behind this shift is protection from external financial pressure. Dollar dominance gives the United States significant influence over global finance, including the ability to impose sanctions that restrict access to international banking systems. For countries facing political or economic pressure, this dependence can be risky. By developing alternative payment systems and currency arrangements, BRICS nations aim to protect themselves from external economic coercion and increase financial sovereignty. The growing use of local currencies in bilateral trade is already showing results. China and Russia, for example, have significantly increased trade settlements in yuan and rubles. India has also explored rupee-based trade mechanisms with several partners. These steps may seem small individually, but collectively they represent a gradual shift away from dollar reliance. Over time, such practices could evolve into a broader regional or multilateral system that supports a BRICS-backed currency or settlement unit. Technological innovation also strengthens the long-term potential of a BRICS currency. Digital currency platforms and blockchain technology offer new ways to facilitate cross-border transactions quickly and securely. A digital BRICS currency could bypass traditional banking systems, reduce transaction costs, and increase transparency. Some experts believe a digital settlement currency, rather than a physical one, is the most realistic path forward for BRICS cooperation. This approach would allow countries to maintain monetary independence while still benefiting from a shared financial infrastructure. If successful, a BRICS currency could significantly reshape global trade patterns. It could encourage stronger trade relationships among developing nations and reduce reliance on Western financial institutions. This shift could create a more balanced global economic system where power is distributed more evenly across regions rather than concentrated in a few countries. For emerging economies, this could mean greater access to capital, improved trade terms, and increased economic resilience. However, it is important to recognize that the transition will be slow and gradual. The US dollar is deeply embedded in global finance, from commodity markets to international debt and foreign exchange reserves. Replacing or even reducing its dominance requires years of consistent policy coordination, trust building, and institutional development. Sudden or forced changes could create financial instability, which is why BRICS nations are pursuing a cautious, step-by-step approach. In the long term, the success of the BRICS currency will depend on cooperation, economic discipline, and mutual trust among member nations. If these conditions are met, the currency could become a powerful tool for economic independence and regional integration. Even if it does not fully replace the dollar, it could serve as a strong alternative that reshapes how global trade and finance operate. Ultimately, the BRICS currency represents more than just a financial project. It symbolizes a shift toward a multipolar world economy. As emerging markets grow and global power becomes more distributed, the demand for a more balanced monetary system will continue to rise. While challenges remain significant, the long-term potential of a BRICS currency lies in its ability to reduce dollar dominance, strengthen member economies, and promote a more inclusive and resilient global financial order.